Welcome everyone to 22 Minutes in Lending. I'm your host, Vince Passione, and I'm happy to have Barry Kirby, the co-founder and chief revenue officer of Union Credit, as our guest today. With over 20 years in financial services industry, Barry's experience spans roles in marketing at Raymond James Financial to leading sales and business development at CU Nexus. Throughout his career, Barry continues pioneering innovative lending solutions, and his insights have guided countless organizations through the evolving lending environment. So Barry, welcome to the podcast.
Thanks for having me. Delighted to be here, Vince.
Awesome. So I've done a lot of research getting ready for this. So I'm pretty excited to hear about Union Credit. So you guys came out of stealth mode at the beginning of the year. True Stage Ventures provided about $5 million of seed funding, I think. Is that right?
Yeah, we closed our round just at the beginning of January, February of 2023.
Great. And what can first let's explain what is the product you launched with?
Sure. So we've created I call it, it's a marketplace. Technically, it's an embeddable marketplace, but it's more of a connective tissue. So one of the challenges in just community banking in general is trying to meet consumers where they are. If you just think of some of my friends here in Long Island, there's a credit union there called Jovia Credit Union.
Right.
Most people walking down the street have never heard of the name Jovia, but they know the name SoFi. And so we built this marketplace that allows us to embed the credit union's products within the native apps that these consumers are using so they could start moving more into that digital real estate things. Imagine things like the Zillows of the world, the Experian apps, the bank rates.
Mm-hmm.
And we're the connective tissue that allows those other marketplaces to be able to extend these credit union products just by plugging into one platform, which is Union Credit.
Yeah. And then, so marketplace, Barry, what's in the marketplace? Is it product agnostic? Is it all products? Is it deposits as well, or just loans?
All of those products. So it's all consumer loan products, as well as deposit products, except we don't do first mortgage. So HELOC, home equity, credit cards, personal, auto, as well as we do offer deposit products, as well as there's cross-selling within both of those flows.
And business lending, is that also part of it or not?
Haven't gotten into business lending yet. We are probably in the next quarter here. We'll be moving into the SMB side of the house, which is just a large personal loan. But the challenge there is to be able to identify an actual business owner, and so you have to go take a little bit more of due diligence there when you're building that product out.
But can you embed yourself in other marketplaces as well?
Yeah, we are embedded in other marketplaces. So for example, we're inside of the Experian app. There's 78 million consumers that are on that daily checking credit scores on their phone. It's a marketplace. We're inside of Bankrate. The challenge right now for these marketplaces, again, imagine like the Experian app is they're our marketplace. It's the same names you've always accustomed to seeing. It's the too big to fail banks. It's the SoFis, the lending clubs of the world. These marketplaces do want to provide their users and consumers with alternative sources as well as just more variety. But the challenge that community lenders bring into the mix is they have geographic boundaries. Credit unions have membership eligibility. As a credit union system, I'm not saying anything we can't say, which is we have a tendency to be fickle. We want deposits one day, we want loans the next day. And so for these marketplaces, maintaining these credit unions is just a very tall order for the output they get, whereas they can just plug into us and we manage all of that for them and then provide them that access to that local network.
Yeah, no, when we launched, we had similar challenges, right? We kind of do some of the same things, and I agree with you. I think it's very hard to get airtime when you're only going to blend $5 million, right? You just get deprioritized, and then you got to get over the hurdle of can you become a member, which sounds like I saw the pun on the play on words, right? Union Credit, credit union, and union.
Yeah.
Makes a lot of sense. We call it democratizing financial services, right? How do you get that balance sheet to be big and to be available, right? Which sounds
Right.
like the technology you built has done that. So I want to jump back to credit cards for a minute because you're talking about what's on the platform. We had Brian Cray on from Navy Federal, and Navy probably has, I got to imagine it's over 50% of all the credit card balances in the credit union system are Navy's books. As I go from credit union to credit union, many of them basically just sold off that product and now they partner on it. As you go around and talk to credit unions and you think about, like, you talk a lot about Gen Zs and about millennials and getting younger. And I was looking at some stats on millennials' use and Gen Z's use of credit cards, which is higher than millennials.
Mhm.
See that product? How do you see credit unions coming back to that product potentially? Because it feels like they walked away from it.
I definitely think they walked away from it. I mean, auto loans have been the past 20 years, auto lending has been the bread and butter of the credit unions. As liquidity crunch comes into play, as rates are increasing, as vehicles are being sold over MSRP, opportunities for the auto loans have dramatically decreased from the credit union's perspective. They're down in the 30 to 40% in the production range in 2024. So now they're looking at, okay, how do we start getting new sources of interest income and revenue? And credit cards have been largely, to your point, they were sold off. They were kind of left, they kind of gave up and said, okay, Citibank has won this. We should just give up. And what we've actually found is we're seeing credit unions that are starting to place more focus on credit cards. The other thing that we've kind of stumbled onto just through luck and some research is SoFi's done actually a really good job with the younger consumer on helping them understand the value of a personal loan. What we have actually found is the value of a personal loan is actually interchangeable with a credit card if you educate a consumer on how these two products are very similar. And so when you start introducing a consumer to say, hey, by the way, this credit card at Jovia Credit Union, there is no annual fees on it. It does also provide, rewards and so forth. When you put that up beside, say, a Chase Sapphire card that charges 500 a year for annual and
Right.
has, it has similar rates, consumers start to understand, okay, I've never heard of this institution, but why would I not take a chance on this credit union versus the traditional Chase card or whatever it may be?
So interesting. So going back and forth between credit cards and personal and secured loans. So my impression is always that because it doesn't revolve, you see this appetite for personal and secured loans, especially when they're sold at the point of sale, right? Versus what you're doing today. What do you see as far as usage in millennials and Gen Zs, credit cards versus personal and secured loans? I mean, obviously, personal and secured loans is a much smaller market, right, than credit cards. But do you see an attitude in your research where younger consumers are opting more for credit cards, if you educate them correctly, or personal unsecured loans because it's an installment loan and I can pay it off in 2 years and don't revolve?
Right. So the '08 crisis is where we basically deemed that credit cards were bad. And so that generation, let's say that was the 20 something year old, automatically started going over into the personal loan space because it was a fixed expense that was basically, it had a monthly installment payment on it. What we're seeing now though is the younger folks that was 20 plus years ago, are not they're not seeing the credit card as a negative thing that came out of the 2008 financial crisis. And so a lot of these younger consumers we're seeing are actually pay down credit card users. From our platform, the consumers that are taking a credit card, we're seeing in the first 30 days that 53% card usage within the first 30 days, which is huge for us because it tells us the consumer's not just sitting on the card and it's collecting dust. They're
Right.
actually using it. So we're actually seeing that the 20 something year olds, the Gen Z, are actually starting to swing back over to the cards, which 23, 24 years ago was very popular until the '08 crisis basically told you that that was a bad thing. Use the personal loan.
So you've been pretty transparent in other interviews, so hopefully you do the same here.
Yeah.
I thought the beginning of the year you quoted like 30 credit unions on the platform. How is that going? How's it? I understand we got some liquidity concerns, which we'll talk about, but how's the growth on the credit union side going?
Good. I mean, yeah, we came out of the gate. In 2021, if I would have told somebody I can bring you more loans and you can handle, they would go, game on, let's do it.
Yep. Yep.
Obviously, we came out of stealth in January of 23, and you say the word loan, and they say, there's the front door. And so, um, yeah, I mean, we had planned on if we had 50 credit unions with the previous economy, we would be able to handle a very good chunk of the consumer demand. Realistically, just due to constraints right now with liquidity, we probably need double that. We're just under 50 credit unions, and we have a bank as well. But again, we probably need to double that. What we're trying to ultimately do is I'm super concerned just about community banking. And I mean, a community bank or a credit union for me are interchangeable because they're serving a community. I'm super concerned about that pillar because right now, even with places like the CFPB and all of these groups that are trying to provide more options, in the end, it's about who has the biggest marketing budget, gets the broadest access, and can basically become the only talk track. So if you go Google credit cards in your area, Chase, Citi, SoFi, Lending Club, and it's like, where are the credit unions and the community banks in your market? They can't spend to
Right.
keep up with these guys. And so for us, it's super important to just start reintroducing these, the best kept secret in banking, which is these community lenders that you probably haven't even heard of, back to these communities and these populations.
No, look, it's tough, even from a regulatory perspective, right? And you hear some of the pundits will say, right, what the Fed really wants is 15, right, major money center banks, and they can turn the dials, right, and control the
Yep.
economy, and everybody in the middle disappears. And maybe what you'll have on the extreme end are these community financial institutions serving these quote unquote financial deserts, right? Which is both an opportunity, right? But also a huge concern about where the overall banking industry is going. But getting back to liquidity, so I was looking at the NCUA quarterly report because I wanted to see where they came out in Q1 on loan to share, and they're about 82.3%, they're saying, for the credit unions. And I was at the CEO conference down in Key West. And there were probably about 150 CEOs there. And the question was asked, is there a liquidity crisis in the credit union system? And I think two CEOs raised their hands. And the rationale was, well, we're just getting used to having to have these levered balance sheets, right? Um, but I guess as you go around, because I see the same thing and I've heard you talk and I have some of the same concerns, is that's interesting. But then everybody came out of their strategic planning sessions last year going, I want to keep my powder dry for my existing members, but then I need deposits. And I scratch my head and say, where are the deposits going to come from? You already have your member deposits. So
Right.
how do you see credit unions standing up to this challenge of loan to share ratios are going to stay higher for longer? You need deposits, and how do you get growth?
Yeah. So yeah, they say all those same comments are said in the board level and the executive level. Also, while saying at the same time they've got to start getting to the next generation, the younger consumers. I mean, you've probably heard these stats, but the average credit union member age right now is 55. If you peel off indirect auto lending, the portfolio from a credit union, it's actually probably getting closer to 60 because an indirect auto loan is usually a one and done type of member. They're somewhat transient.
Right.
They got an F&I who sold them on a payment, didn't sell them on the credit union and what they serve. And so we kind of educate them that, listen, liquidity is not going to be a challenge in 5 years at the rate you're running at. Because at a 65-year-old consumer in 5 years, if you've done a good job as a credit union or a local lender, they shouldn't need any money from you. And so how are you going to get to the next generation? And then they say, well, we need to get deposits. Well, a 25-year-old doesn't have any money underneath their mattress for a CD. And so that's where I think as bankers, we tend to forget just like human logic, which is I have a need. So I'm a 25-year-old consumer. I have a need. Maybe it's a need for your personal loan. When you make that exchange, that's when you start developing trust and you can then ask for and barter in exchange for, hey, we'd like you to move your payroll over. And for doing that, we can reduce your rates. Like that's how you can grow the deposits. They're going to be mostly micro deposits, but I mean, payroll in the end is where you start getting back to some sense of a PFI. And that has largely been relegated due to just the fact that credit unions have been super gung ho on indirect auto lending, which is where you're not going to get a payroll. You're getting one auto loan
Right.
and it's through a dealer channel. And so now they're starting to shift back to, okay, direct loans are where it's at. We should give these consumers what they need up front because that's our job. And then ask for an exchange once that trust has been developed. Can we move your payroll over? Have you seen our $500 checking account? Whatever it may be, and then start moving towards that direction.
So CDFIs, you launched an initiative with CDFIs. We had Shirley Senon from CU Strategic Resources not too long ago, CU Strategic Planning, and we discussed CDFIs. And Shirley does a great job of explaining. So this is an entire ecosystem. Like there are 2,200 credit unions in this, but there's also community banks. You've got venture funds in it, and you're really making a commitment to join a community that's trying to service, right, this specific population. You entering into the CDFI space, what's the objective there for you, and what's the objective for your clients?
So actually, this idea was not my idea. It was actually a conversation we were having with a bank in North Carolina, which is where I live. And they were like, it would be amazing if you could identify the census tract of a consumer, because that's how we identify if they're in a low or middle income type of area. And we started talking, and you start just taking your lenses off. If you look at a lot of these communities, they're payday cash checking places behind every bus stop. There's, a payday lender on this corner and that corner. These credit unions and banks don't have like brick and mortar presence within these communities, but all of these people in these communities are on digital devices. So the question is, can we reach into those devices and identify there's somebody who needs to be served, and can we do it proactively? And so we are now, when we basically pre-screen a consumer, we get back their census tract, which tells us, are they in a specific community? And
Right.
so now credit unions and banks have trouble as it is showing an examiner or the Fed that they're proactively trying to serve that community. Whereas now we can say, hey, look, you are proactively doing it. Whether they select your product, I can't force them, a consumer, to select your product, but we can say for a fact, you're trying and you're getting on those devices. And so it's really just giving them another tool to start helping those communities and really start targeting them digitally.
Yeah, it's a tough time in CDFI land, right? Everybody has to recertify. So, and I think that
Right.
has been happening for 5 years, according to Shirley. So all these credit unions now have to demonstrate that they are actually doing what they said they did when they first got that designation. So it's good timing. It's very good timing. So we started off talking about your founding and venture funding, and we've had plenty of different guests on. We had Matt Harris from Bain, who says that we're not going to get back to where fintech was in 2021 for years. We had Nick Evans on from Circle Fund, and Nick talked about, hey, there could be a potential saturation point where there's just too many of these. Now we see that investing in fintech has kind of trailed off. AI is the new shiny object, so some of it's diverting there. What's your view on the world, especially being in the industry, when you see credit unions now, right? There's about three different funds. There's Circles, there's Reseda, there's another one. They're all investing in these fintechs. At what point do you think this is just there are too many fintechs chasing too few opportunities?
Yeah, I would have said that was 5 years ago.
Okay.
Yeah. Yeah, I mean it's unrealistic to think a credit union strategic team or board is going to have the capacity to look at 11,000 fintechs that are out there. I mean, every fintech you talk to, and I'm guilty of it all. We all have the formula that's going to solve everybody's problems. Um, I talked to a board last year. Actually, they were had a similar question. They were like, "There's too many fintechs. We could review 3 demos a day and not even scratch the surface. Where do we begin?" This board was asking me to talk to them about this. And I just told them flat out, I was like, I think you first need to reverse the way you're doing this. You need to identify your top challenges today for survival. What are your challenges? We need new members. Great. We need liquidity. Great. So you got to, as a board, they need to define those categories. And then you need to go find a couple of good players that you think can start making an impact within those categories. And so that's kind of how I look at it. There's a ton of these fintechs out there there's so many niches out there. It's just, and I try to just, even when I worked at CUNY Mutual, and which is now True Stage, I helped out on the venture side, and it's focus on the things that are going to move the needle.
Mm.
Is what it comes down to. Will this move the needle? Is it a shiny object? I mean, you can just say AI and machine learning and they'll get money, but does it actually change the way or their outcome of what's going to happen? And that's what we've always stay focused on, is anything we're going to build, if it doesn't have a true impact and have a significant impact to the people we're selling it to, then we probably should find a different idea.
Yeah, and it's also, I think, the phase we're in, right? In the beginning, it's about it's always been about disruption, right? To get started,
Right.
internet, right? And now where we are with things like AI, it's one product. It's not even a company; it's a product, and it
Right.
disrupts. Now we're back into sort of reaggregation, right? People want to see complex systems come together. Um, and that's why I think you'll see much more M&A activity, which will be driven by two things, right? The first is funding's drying up, so you're going to see M&A. But I also think people have realized that, okay, we're at that phase where that little product that you built standalone isn't a company. It needs to
Yeah.
be connected to something else. Now, but part of the business proposal from when I think about Circle and True Stages, and I hear Nick say this a lot, he'll say, we get credit unions. So when you, as a fintech, take money from Circle or True Stage, you'll get one of us on your board and we get credit union. So True Stage is an investor on your board. I know you want to be careful what you say about them, but is that part of the value proposition to you? I mean, you get credit unions. You've been in them for 25 years. So how does that work as a founder of a fintech with True Stage?
Yeah, it's a little bit different for Dave and I, just because we've been around for long enough to have our own credit union networks. But I mean the value, like for example, like a True Stage brings is they have 95% of all the credit unions use them in some type of way. I mean, their bonds, their insurance. I mean, they're a major pillar of the credit union system. And so for a lot of new fintechs, for example, the True Stage is almost like this badge that it's been vetted, even just from a due diligence perspective. We know this thing is buttoned up, and if you buy it, in the worst case scenario, we got the money to prop it up if it's a critical vendor for you. And I mean, let's be honest, credit unions and community banks, I mean, we're in the business of reducing risk. That's what lending is. They're all about looking at the risk of a consumer to default on a product. They look at vendors the exact same way. And so they're not very apt to go with something out of just no man's land that hasn't, have any type of relationship with Circle or True Stage and things of that nature, and just roll the dice on it, because that poses a large risk to them in their mind. So I think that's really what it does. I think it helps just from a perspective to say, well, it's backed by True Stage. It's in the ventures portfolio. How bad could it be? Or it's in the Circle fund. Obviously they've done their due diligence as well. They're not betting on dogs either. So I think it's a lot of just of mental, as well as, I think I can't speak for the other fintechs. I mean, we don't necessarily use the distribution hub as much, but I certainly know it exists, and other fintechs are using it. It's definitely helpful for them.
Yeah. No, it makes sense, right? Especially given how close the industry is, right? It is a
Yep.
referral industry, so it does make sense. These are both individuals and companies that people
Right.
know, and it works. And given your network, I can understand how Union Credit fares, right, and not having to use much of it. So you've been in the market since the launch, right? Any kind of pivots or things you want to sort of talk about that you think what's the future for Union Credit as you see what's happening in the industry since launch?
Yeah, I mean, so we have phases to our launch. So our first phase was almost what I would call offers as a service. So being able to generate pre-approved offers on behalf of a network of lenders, and then embedding that within the places where consumers actually are.
Right.
Consumers aren't going to joviacreditunion.org. They don't even know what it is. Most of the people who go to the credit union or bank's website are their customers. So you got to start meeting them in this digital real estate that most local lenders can't afford to get into. So that's kind of phase one. Phase two is now for us is then extending that experience to the point of transaction, the actual checkout experience. So imagine you're going to Tesla sells solar panels for your house. Let's say you're going to Tesla right now. There's a world where, let's say you're one of the people that were pre-screening you into perpetuity, which we have access to 90% of the population of the US. You pop up on Tesla, you look to see if you're already pre-approved one of the credit unions. You now grab the asset you want to purchase, and you then go check out using a pre-approved personal loan, whatever the product may be. So it's taking what buy now, pay later taught us, which is consumers will take financing at the point of transaction, but bringing traditional products into that mix versus this untraditional product, which is buy now, pay later.
Makes sense. Makes a lot of sense. Well,
Yeah.
exciting stuff. I wish you an awful lot of luck.
Thank you.
It sounds like an amazing product. So thank you.
Thank you. Thank you for having me, and appreciate the opportunity to chat with you and spread the word.
Absolutely. And thank you as always to our listeners. Don't forget to subscribe so you can enjoy future episodes, and I'll meet you back here for our next 22 Minutes in Lending.
Thank you for listening to the 22 Minutes in Lending podcast. We hope you enjoyed today's episode. You'll find links to any resources mentioned in the show notes. If you're enjoying our show, be sure to subscribe and leave us a 5-star review.